Chris McAlpin with Sound Financial, and I hope you're doing well today. Every month, we want to give our clients a short update on what's going on in the markets, what's going on in the economy, and what's going on in your models and your investments and how they should react to the markets and the economy. And in these conversations, I hope you get an idea of what we're thinking or what we're writing. You see the other podcasts, the chase, and the articles that we're pushing out. But this one is directly for you, our clients, our friends, what we're working on, what we're seeing out there in the broad world. So the first thing that I want to talk about is the growth to value rotation. We're seeing this, we've been seeing it for a few months, and what happens in the early stages of an economic recovery is the growth stocks that have been really running up, think Facebook, Apple, Amazon, Google, Netflix, Microsoft, and how they've really run up, they start to pull back a little bit, and value stocks like your Walmarts, your Coca-Colas, your Home Depots, Clorox, companies that really do well in a growing economy start to step in to those spaces. We're starting to see that. I think two of the indexes that you can look at, watch the Dow Jones Industrial Average, watch the NASDAQ 100. At the recording of this, yesterday at the market close, the Dow was up pretty nicely. The NASDAQ 100 was down big. You're going to start to see some stuff like this happen. Now, it's messy, it's not even, it doesn't happen on an everyday basis, but we're definitely seeing the rotation between growth to value. Number two, in the last 12 months, we've had over $5 trillion pushed into the markets and the economy. Between the Federal Reserve and the U.S. government, they're pushing tons of dollar bills into the economy to keep the economy up, to try to pick up that downward leg of the K-shaped recession. If you remember almost a year ago when we started talking about a K-shaped recession, I said I'd never studied one, never seen one. I've seen one now. It is a K-shaped recession where some people have done well, some people have not in the initial downturn and the recovery. So we're seeing that dollars being pushed into the economy. The government just passed a $1.9 trillion stimulus. That's going to be pushed into the economy. Now, this is going to push interest rates up. This is going to stoke inflation fears. And it's going to cause havoc in the bond market for a little while. That is a short-term problem. In the midterm, what the government and economic leaders are trying to do is not fall victim to doing too little for the economy. They want to push, and they would rather make the mistake of doing too much for the economy, trying to get people back to work and trying to open the economy back up, than the fear of doing too little. That is going to push inflation in the future. It is going to cause us to have to do some bond management in the future. I think in the short term to midterm, it will be helpful for the economy, but it's something that we're going to watch. Now, number three, how does this affect your investments? In the last couple of weeks, we've rotated out of gold. We've rotated out of momentum. We've rotated into value. We've rotated into small caps. And so in our moderate portfolio, as a kind of central portfolio, we're holding large cap value, small cap positions, international positions, and high yield bond positions. Exactly where we would want to be, or exactly where we do want to be in a growth to value rotation, exactly where we do want to be in a recovering economy. Now, as I said about the growth to value rotation, it's going to be messy, it's going to be uneven. It's not going to be something that you can pull up your account statement today and go, oh, voila, it looks good. Yeah, exactly. It's going to take time for this to flow through the markets and for us to start seeing some results. We're very confident in the models that we have you in. We're very confident in what we thought we were going to see, we're starting to see. And this is where our rules-based investments really start to help us, because we're able to look at history to build a portfolio today to attempt to do a very good job for you in the future. And I stress the word attempt, because we can't predict the future. We can't guarantee results. Common sense won't allow me to do that, right? But we think that these are going to do a very good job for you. We're happy to explain them in greater detail. Give your advisor a call, give me a call. We'll talk about it. Look forward to talking to you, and I hope very soon that we're looking forward to, or we're setting up client dinners so we can actually shake hands and slap backs and see each other. It'll be good to see a lot of you. Thank you very much. Have a good day.